Welcome to Private Markets 360, where we delve deep into the world of private markets and bring you insights from industry leaders. Today, we have the pleasure of welcoming Jacob Mueller, co-founder and chief solutions officer at Opto Investments. With a distinguished career that began at Bridgewater Associates, Jacob has cultivated a wealth of experience in the investment landscape. At Opto, Jacob has been pivotal in working with RIAs and family offices to develop customized investment solutions across private markets. Opto's unique approach emphasizes a deep understanding of its clients' needs, moving beyond a traditional menu business to create bespoke strategies that really align with clients' investment goals. Jacob brings insights into the current macroeconomic trends, deal flow management, and the evolving landscape of private equity and AI. We're excited to explore his thoughts on the future of private markets and how investors can navigate these complex waters. Jacob, welcome to the show. We're delighted to have you join us today. How are you?
I'm doing great. Excited to be chatting today. A lot to discuss.
We certainly do have a lot of great ground to cover and some pretty diverse topics, but it'd be great, Jacob, to just start off with a walkthrough of your career journey from Bridgewater to co-founding Opto and how your experience along the way has shaped your thought on investing.
Yeah. So to rerun all the way, I got passionate about investing at a pretty young age. I grew up in San Francisco, sort of came into cognizance during the dot-com boom and bust. Saw our next door neighbor go from driving a beat-up old Honda to a Ferrari back to a beat-up old Honda over the span of about 2 years, and thought, that game looks pretty interesting. I should figure out how to play it better than he did. My dad set me up with a very small portfolio when I was 8 or 9, and I've really not looked back. By the time I got to college, I was running strategies in bonds and commodities for friends and family, and was writing about that, and got pretty lucky that some of the investment folks at Bridgewater were reading that writing. So I got invited to come there first as an intern, returned, spent the first 4 years of my career as an investor, and really couldn't imagine a better training, really just digging deep into the true logical linkages that tie the economy together, how players operate, how they come together to set prices, and how those prices can evolve versus expectations. By the time I, was a few years in there, was primarily looking at our risky credit book, and so emerging market debt and high yield fixed income. And especially on the high yield side, noticed something both interesting and frustrating, which was that we could get credit conditions right, predict really well what was likely to happen in terms of demand for borrowing, supply, how those players would meet. But the strategy wasn't working that well because so much of the marginal buyer and seller activity, the really important transactions that were fueling growth, was moving to the private credit side. And saw that story repeated on the equity book. It's always been true in real estate. And so got really interested in how you could apply a fundamental and quantitative understanding to really level up how these spaces operate as data and availability has grown. On a personal side, it got a lot less hard to pull 90 to 100-hour weeks to put on what I knew was not the best trade. Not to say I was always putting on the best trade before that, but once you're not, at least for me, this is all about how do you be the best at what you do. And once I knew I really couldn't do that, at a $100 billion fund levered 10 times on average, the writing was on the wall. And so lockpicked the golden handcuffs there with these sort of vague notions of how do you apply a systematic understanding in this sort of fundamental framework to improving and evolving the private market space. From there, it was really just right place, right time. One of those very lucky accidents. I was driving back to San Francisco. I grew up from New York, and somewhere in the middle of Iowa, a guy I'd overlapped with for 9 months or so at Bridgewater called me and said, I really think you should meet my boss. It's this guy, Joe Lonsdale. He co-founded Palantir, founded this firm Matapar. He's thinking a lot about the private market and alternative investment space. And, I was being clear, so I thought, why not? And, the one unfortunate part was Joe wanted to go on a run the next Wednesday. I had not run in a very long time. We're not on video, but more of a power lifter body type. And so spent the next couple of days practicing running, talking, and trying not to dry heave. But luckily that meeting went well, made it through the run turned into lunch, turned into 4 or 5 hours at the whiteboard. What Joe had been noticing as chairman of Matapar was just how rare it was, even in large sophisticated groups, let alone, this broader RIA and fiduciary community, to have a really robust and efficient access point to private market, and one that participated in what he saw as the most exciting spaces, the things that his family office was doing, and the investors he trusted most. And as we got together and thought about this, it became clear why that was, which is that this industry sort of grew up over the last 10 years, solving for access on the side of the GPs. And so most firms in the space, conceptually really look like a broker or a placement agent, and they're paid some commission by the largest fund managers to raise, what they see as retail capital into the largest funds. And that creates a number of adverse consequences. One, the best funds don't have to pay to raise capital. They tend to be really diligent about how large their fund size is and are oversubscribed. And so why would I pay 2 to 5% to raise capital if I'm actually having to turn investors away already? And then because of how you're incentivized, you really just focus on the largest funds. And again, maybe 10 years ago, access was the problem. That's not the case today. And the largest funds are going to end up looking something like private market beta. Now, there might be space for beta in a portfolio, but you certainly shouldn't pay 2 and 20 for it. And so we thought by bringing the best technologists from Palantir, from Adapar, from our network, and to approach this problem on the same side as our clients. So we are our fiduciary ourselves. We are aligned with our clients. We are buyers on behalf of, not sellers too. That would allow us to both source and create better investments, but also build better technology. If you are incentivized to sell say, a given mega cap REIT product, you're never going to build a portfolio construction engine that doesn't recommend that. But that might not be the right investment for all clients. And so by not buttering the bread on both sides and getting incentivized to pay, to sell funds to people, we could really build better, unconflicted and opinionated technology, where it was really just about how do you drive the best outcomes at scale.
So many insights in that whole response that you gave. I mean, I love the fact that you started investing young and kind of had that passion for it and continue to do that today. I love just what you kind of noticed about the markets and taken that into your career today. And I do think it's very interesting as more and more of the retail space is getting into private markets, all the different ways that's happening, all the different fee structures. And, I'm always curious about how those fee structures are really ending up incentivizing what is being recommended. And I think there's huge opportunity, like you mentioned, to kind of have an unbiased from a fee perspective, which is really good kind of technology that is able to help with that portfolio construction, like you mentioned, based on that desired outcome, which we know can be different from investor to investor. So Jacob, sharing that whole journey.
Yeah, and we even go a step further in terms of how we've structured our business model. Joe and I are both obsessed with alignment.
Mm-hmm.
Basically, I'm a walking Econ 101 textbook from that perspective. But how do you really turn that on its head? What we saw an opportunity to do was use technology to get ongoing fees and costs as low as possible, but partner in the upside. And so we charge a really low technology or management fee, depends on the structure, that really just keep the lights on. We're not actually trying to really have any profit margin on that. But then we have a 5% carried interest on the back end of these funds that is set relative to the goal for these clients and has a pretty high hurdle, so that in the normal course of business, people are not paying high fees for access. They're only paying if we do what we set out to do and get people into ideally top quartile funds across private markets. Now, I've been on both sides of this. It is very frustrating when your manager is charging you a few percent plus expenses and performance is lagging. It is a lot less frustrating if you are being returned 3 to 5 times your money and there's a small 5% consideration. And what that does is it really makes us really diligently aligned with the client outcome and focused on delivering the best of private markets to portfolios relative to what people need.
Yeah, I completely agree. When I started out in investing too, it was alignment was key. So many different aspects. So I really think that's great that you guys are focusing there and then expanding from that point. So now that we have explored your experience and approach, let's shift our focus to the broader context in which these investments are made. So the macroeconomic landscape plays a crucial role in shaping investment strategies. And to kick off the discussion, we'd like to get your thoughts on the global macroeconomic outlook. Would you help us understand the current landscape by addressing really two key questions? First, what are the most significant macroeconomic trends impacting markets today? And second, how should investors navigate these changes?
Yeah, so I think we are at a true inflection point. And what's interesting is that we should have a really clear timestamp on the forces that have sort of played a dominant role backward looking. And it looks like those forces are set to revert. And so if we pull the clock back and go back to the early 80s, so roughly 40 years ago, interest rates were very high. This was, just after the Volcker tightening. Globalization was at a relatively low level and was starting to increase, but was still relatively low. And our economy was still heavily geared towards relatively low margin activities in manufacturing and other sort of high input cost areas. Over the last 40 years, interest rates have, with some ups and downs, fallen, but by and large, the most recent peak was lower than the previous peak, and the most recent low was lower than the previous low. That has obviously started turning around starting in 2019 and into this most recent tightening. We're still not back anywhere near Volcker levels, but you've gone from this massive tailwind, falling interest rates, to at least it being a neutral. And it seems more likely than not to be a negative than a positive. And that has a myriad of effects. One, obviously lower borrowing costs, spur borrowing, which spurs spending. That's through the mortgage mechanism, that's through business borrowing, consumer borrowing, and it's also through a lower cost of debt service. And so you can refinance existing debt and have more of the income either as a corporation or an individual to spend. Globalization was a major role too, both in terms of obviously outsourcing to cheaper areas of production, which really picked up steam in the 90s into the early 2000s. It actually peaked in the late 2010s just before COVID, but was still at a relatively high level. And that also had a large impact on the role that foreign sales have to play for U.S. equities. We've gone from less than 20% to over 41% of sales coming from overseas for roughly S&P 500 companies, and even more of the sales growth, that delta, which ended up driving a lot of equity performance. Look, everyone in America already owns an iPhone, basically. That's not true of India. And so Apple counting on new markets being a major source of revenue growth. With the current tariff volatility, and there's a lot still unknown there, but seems very unlikely that increased globalization will be a tailwind. And if anything, it seems likely to reverse course and be a pretty significant headwind. And then you have a change in the sector composition of our economy, going from low margin manufacturing and durables to largely a technology and service-based economy, and definitely an equity sector tilt there, which has increased margins and increased measured productivity based on how those sectors tend to work. And so you can explain a lot of the sort of amazing performance of the last 40 years in risk assets through the lens of these three factors. And we look set to have all three go to at least neutral, if not pretty significantly negative. I did an equity decomposition because you can go through, the margins, the sales growth, the impact of, the cost of debt service, also the discounting of cash flows due to interest rates. Over half of equity returns can be explained by the shift in these three forces, which seems unlikely to repeat. And so, I look out at that economy and I see a risky period for risk assets where we are quite unlikely to see the same returns from sort of holding a balanced beta portfolio on a forward-looking basis than we have on a backward-looking basis, with upward pressure on margins, downward pressure, at least on foreign sales, if not second order on domestic sales as well, and an interest rate environment with a lot less room to cut and a lot of potential room to hike if inflation turns out stickier than expected. And so I'm a student of history. This is why I think it's important to really zoom out at important times like this, where it feels like a lot is changing, and really question what feels like things you can take for granted. Almost everyone who's active in markets today has only been active during that 40-year period, where those forces have been pretty significant and pretty constant tailwinds. What does it mean to be in an environment where those go away or even reverse course. And then how do you navigate it? I think you have a couple, this is maybe why economics is called the dismal science, but you have a couple options, some of which do not feel particularly good. You can accept lower returns. If maybe beta returns half of what you got on a backward-looking basis, perhaps cash rates are a little bit higher, but it's not going to make up the gulf. You can take more risk to move out the risk curve or use leverage to get back to where you think you need to be or what your expected return is. But in an environment of increased uncertainty, I'm not a golfer, but I think of it like putting on a ridge where, maybe there's a straight path to the hole, but there's two hills on either side that could send the ball careening in a couple directions. Just taking more risk blindly does not increase your probability of success and can deeply increase the risk that you are way off of where you need to be. And then, we see it as you have one more palatable option, which is how do I take better risk and how do I add diversifying alpha to portfolios? And so, that's a lot of why we focus on private markets. From a diversification perspective, you are talking about generally different slices of the economy. How will trade wars impact the lower middle market versus the large cap equity sector? Well, the lower middle market is much more domestically focused. If we have to rebuild manufacturing here, it's likely that the companies building and operating those factories, doing logistics and transportation between them are largely in the middle market sector, not the large cap sector. And so could actually be a slight tailwind there. And then, due to the illiquid nature of these investments, you don't have the same sort of autocorrelation from all investors pulling and broad level investor behavior. And so can be a very diversifying sleeve, even if you don't think you have access to real uncorrelated alpha opportunities. But then we do see it as a place where the opportunity to outperform is much greater. I have a very simple framework for what drives market outperformance. You really only can outperform one of four ways. You can have unique access, you can have unique information, you can have unique insight, or you can get extraordinarily lucky. The first two are illegal in public markets. That's insider trading. Do not pass go, do not collect $200, go straight to jail. But that's the lifeblood of private market. And that's not, nefarious backroom dealing. It's as simple as if I'm the best investor in healthcare venture capital and the next all-star team spins out, you've got, the right research scientist, someone who's built, a repeat founder in the space who knows how to get this done. They've got early clients, they've got early traction. Who are they going to reach out to first? They're going to reach out to the firm which conveys the best vote of confidence if they win that capital, and that's generally the best investors there. Those investors already have more information on the space from prior investments. They have potential customers, partners, acquisition targets in their portfolio as well. And so you see a lot more serial correlation and stickiness of alpha in private markets due to information and access being such key drivers. And so with that broader macroeconomic picture, we're really urging investors, with us or outside of Opto, to think about how they can add more win conditions to the portfolio. Rising tide lifts all boats. If the tide doesn't continue to rise, where does your portfolio sit? What risks do you have? And how can we mitigate those risks?
And I think that plays right into the next theme we wanted to discover with you. And that's the process at Opto for managing deal flow, for taking all of that into how you're tailoring portfolios for clients. And this concept you have of boring AI, which I think is going to be really interesting to pull apart here.
When we say boring AI, what we mean is, look, there's a lot of areas in AI that are, if not frothy, definitely have a lot of pretty extreme expectations baked in. And that's a lot of the consumer-facing applications. That's a lot of the ideas around how, basic parts of the workforce can be replaced. It is likely we see a pretty seismic shift, but that's more likely to play out over 15 years than over 5 or certainly over the next few quarters. Where we get actually most excited is some of the really practical applications in legacy industries. And so, healthcare billing, for example, which is just hospital systems going back and forth with insurers on, which codes are we using? What discounts did we negotiate on those codes? Can we use this code? It's $280 billion a year of expense, which is essentially just deadweight loss. There's no value from that. It's just that we have a very inefficient way of working between those parties. If you can set up AI agents who sit on both sides, and we've already seen this in a couple of systems and some early pilots, you can reduce that cost by 80 to 90%. And that means people getting treatment faster. That means healthcare costs going down. and more time spent on actual patient care. Similarly in logistics, if you can go from trucks that are half full and 3 weeks of lot time to on-demand delivery and full trucks based on better transparency and the sort of AI inventory management, you could significantly reduce transportation costs in the order of 15 to 25%, which in a very low margin area is highly impactful. And you can keep going through examples of this in construction and permitting, in legal services, anywhere where you have these repeat tasks that are basically following a script. And right now we have humans following that script, and it's not a particularly efficient way to do things and has time lost in communication. And you can tally those up across our economy, and the impact is pretty significant. Now, who is the benefit going to accrue to? There might be a bit of benefit that accrues to some of the major players in public markets that people might think of, the NVIDIAs, Microsofts, cloud hosting services, et cetera. And if they can figure out the business model, perhaps some to the model layer of AI, the Groks and OpenAIs of the world. But a lot of this is about who's actually using it on the front end. And so these very practical and very quote unquote boring applications in legacy spaces. And this gets us really excited on the private market side because largely we're talking about businesses that are supported in the lower middle market space. And how did you look like a genius in private equity from 2010 to 2020? Well, borrowing costs were basically zero and markets went up. So you bought anything on leverage that cost you almost nothing. It went up and you looked really smart. That is not the case anymore. Borrowing costs are quite high and markets are somewhat turbulent. But if as a private equity manager, say with a focus on logistics, if you can acquire companies, insert agent layer tools, and increase margins by 10 to 15%, at a modest leverage 2 or 3 to 1, you're talking about really exceptional top quartile returns. So really looking at the space in the economy that are most underserved by the last couple technology wave, where AI has the potential to play a much larger role, and that a lot of market participants overlook because it's not sort of the very glitzy side of how AI might be used, but is probably going to be the most important over the next 5 years.
So it sounds a lot like pattern recognition, that taking an existing process, understanding what are those patterns, and then saying, how can we do this better with boring AI, so to speak?
Yeah, and looking for those, there's a couple criteria. You want to have very repeatable processes.
Mm-hmm.
You want to have pretty rich data ecosystems. And, in terms of the marginal impact, looking for spaces that have largely been sort of stuck in productivity ruts and behind the adoption curve in previous waves. And, we've identified a number of those spaces and are very interested to see how this rolls out.
So building on that, let's talk about another critical step in the investment process, which is fund selection, due diligence, benchmarking. What do you use for benchmarking? And can you describe your process for fund selection and diligence? And also interested what role AI is playing in this aspect of your work.
I see it as a pretty deep kind of human-machine symbiosis there. I don't think AI tools are going to come for call it the last 30% of the diligence process anytime soon. We think it's really important to do the site visit, to see people in person, dig really deep and ask questions that might not come up otherwise. But the screening step, in terms of how many deals can you see, how much knowledge can you have about the overall space and how things are moving, is a really great place to apply modern database systems and artificial intelligence. And so, what we see across our clients, family offices, we can have some more institutional investors. This is still largely done in terms of people communicate via PDF. PDFs are a terrible way to send numeric information. Why would I take a photo of the number and send you the photo versus just sending you the number? And then tracking in Excel and other tools that are really not purpose-built for an allocator to build their understanding of the world and create a data moat. And so we built tools that can pull in whatever materials you have in a manager, a 2-pager, a PPM, an LPA, a deck, account statements, and start to build a really context-rich profile that then you can auto benchmark based, overall on asset class, based on sub-asset class, strategy, manager type, a lot richer experience than just saying, hey, I'm top quartile in venture. Well, what does that mean? What did your actual peer group look like? And, you can look at who are your co-investors? How did they do relative to you? Were they slightly better at selection? And then thinking about what that does over time to your understanding of the world. As you continue to build out that data set and you see more and more documents, we preloaded the system with data on tens of thousands of funds. But if I've seen, call it, 200 ppms over the last year, the ability to then come in and this is actually something that technology is much better at than people, really benchmark the terms. Like, hey, for the managers in this space, these fees are off market, or this way that the fund manager and the GP are compensated per deal is not investor friendly. And so that pattern recognition across really dense legal documents and being able to turn that into human scale information that is really actionable helps you get from that, hopefully as broad a net as possible, thousands and thousands of deals a year, down to the few hundred that you really want to go deeper on and add the human touch. And so we, from a sourcing perspective, we still think network is of the utmost importance. And so a lot of our sourcing comes from our investors and backers. And so that's, firms like the Government Investment Corporation of Singapore, they see thousands of managers a year, and we're able to go to them and say, what's the best thing you've done in the last 3 months in this sector, and largely get access. A number of the top family offices in the country are on our cap table. And we really want to know where the best allocator is actually putting money to work today. And from that, plus obviously we get a lot of inbounds, and then there's just funds you hear about in market, build that set of 5,000, 7,000 deals, quickly screen as many as possible to build a view of the world, and to allow you to decide on the few hundred that you really apply your human resources to go a step further with.
It's a really interesting way of taking all of these parts of the investment selection process that have historically been, done through spreadsheets or done through conversation, and try to systematize them, and then leverage networks and that personal piece that you're talking about to enrich that. And then obviously leave that space for the investment decision-making, which is going to largely be a personal process for some time. So really interesting to hear you break that down end to end. As we look ahead to the next 5 to 10 years, we'd love to hear you just kind of openly muse with us on your conviction around the performance of different asset classes, what trends we expect to see in private equity, just kind of taking a really broad view. What do you see coming down the pike?
Yeah, so one area we're a little worried about is the large side of private credit. There's obviously a massive amount of money flowing into the mega BDCs over the last few years, billions and billions of dollars a quarter. And that creates some issues. If you have a investment team of even 30 to 50 people, there's only so many deals you can do per quarter. And if you're running one of these semi-liquid structures, you have to put that money you raise to work pretty quickly. And this creates a lot of competition for deals among those large managers. And for loan sizes, call it 200 million, 250 million and above, we've seen a real degradation in terms away from the investor. That's much lighter covenants, that's lower spreads, that very little collateral coverage, if any. And I don't see it as a blow up risk, but I do see it as actually worse risk return than even the high yield market right now. But that's been one of the most popular places in private markets for the wealth community. And so we're watching that pretty closely, especially as impact from tariffs and higher costs flow through a lot of the companies that they're lending to, which had pretty low sales margins and pretty high debt levels. And really the only players with enough balance sheet to refinance are the players already lending to them. And so we see some outsized risk there and are largely advising folks against participation in the large loan size area right now, and are, expecting some troubled waters ahead there. In private equity, again, I think those firms that can figure out how to intelligently embrace artificial intelligence and do that practically, and hire the right people at the private equity GP level who can filter the wheat from the chaff in terms of what's possible and which players are real versus which are smoke and mirrors, are going to have really, really awesome opportunities over the next few vintages to just pick up some really low-hanging fruit in terms of improving legacy processes with this new technology. The last productivity wave we saw was in the early 2000s, a manufacturing automation wave, and that did pick U.S. potential growth up above 4% for about 4 or 5 quarters. I actually think this impact could be larger. It might take a little bit more time. I think the adoption curve will be slower. But I've sort of built out bull, bear, base case. I think our base case is around that 4 to 4.5%. But if we look at some of the most non-productive sectors, healthcare, real estate, logistics, the real impact that models can have there could push potential growth back up above 6%, which would be transformative for the U.S. economy. And we think that benefit would largely accrue to really operationally focused private equity managers and the firms that they work with. Venture capital is always, it really stands apart. Early stage is so idiosyncratic. It really is about founder networks. It's a bit about picking the right trends, but it's so much about finding the right teams and identifying spaces that are the least crowded. And we do see opportunity there. There's obviously really crowded parts of AI, but there are less crowded parts on the deep tech side. And that's, database management, developer toolkits. Think all the things that had to be built for the cloud wave to support non-on-prem development. A lot of those basic toolkits for building AI applications, I think we're still to identify winners, even if we know that the GPTs and XAIs of the world are likely to dominate the model layer. So we're pretty bullish on the right sort of really deep tech expertise in the early stage. There's still some pain to work through in late stage. So many companies over-raised at high valuations in 2020, 2021, and raised so much money that they haven't actually had to come to that realization point and either raise a down round or something more extreme. That is starting to trickle out and is likely to pick up in the next 6 months. And so we think it's a double-edged sword. There'll be opportunity actually for perhaps growth equity managers to get really low valuations on deals that need pretty acute injections of capital, but also might be a bit of pain for sort of traditional late-stage venture growth equity managers just sort of betting on a rising market. We're starting to see a little bit more IPO activity, but I think market volatility will likely dampen that through at least Q3. And then, real estate, we are starting to see green shoots. That's been sort of persona non grata since COVID, and there was some overbuilding in 2019 into COVID that we're still working through. But there's areas of multifamily outside of tier 1, even tier 2 cities where you're starting to see real recovery in cap rates, and we're not quite at margin of safety levels yet, but getting to the point where if you have the right sort of unfair advantage in that market, there are some pretty interesting opportunities. And then the real estate debt side actually being pretty interesting right now, with a lot of regional banks stepping out of that market, opening opportunity for people with really deep expertise and underwriting abilities to provide real estate debt, both in commercial and industrial.
Something else that we'd like to explore too is thinking about how investors really like liquidity. And so private markets are adjusting to meet that requirement and open up access for the retail investor. But as they start investing in private markets or get access to it, what's the trade-off?
Look, there's no way to fundamentally make something that is illiquid liquid without trade-off. And for some investors, at the accredited level, that trade-off might be totally worth it. The need for liquidity is present. If I deciding to buy a house or do something else with a limited amount of capital, I wouldn't want to be in a 10-year lockup. But it comes with trade-off. And you have to have a relatively large cash balance in those funds. And that's a drag on returns. And you're also paying someone management fees and performance fees to hold cash for you. And then there's the risk of what your counterparties do. And so we've seen this with a number of the large REITs, S-REIT, et cetera, having to put up gates and stop redemptions because everyone heads for the exit at the same time. Well, you get rid of the cash first, then you sell the most saleable security second, and you're left with the stuff that would be a pretty significant markdown. And so you're forced to put up gates. And so we urge people to recognize that even if something is billed as semi-liquid, it tends to be liquid when you don't need it and not liquid when you do. For investors, with 2+ million in net worth, we also urge people to really think, what is your illiquidity budget? Is there some portion of this that you really don't need to touch for 5, 7, or 10 years? If there is, probably the best access point you can get to private markets is going to be in a diversified vintage approach. And so finding drawdown managers, working with the RIA to build a custom exposure. So, your diversified growth fund or diversified income fund, and building into that almost like a mini bond ladder, allocating each year so you get to the target for your portfolio that you need to, and then being able to essentially wind down by just not reinvesting if that is what's needed. But then you're exposed to a lot less risk. The dollars are in the ground. You have a full business cycle. The idea is to play out and to mature. You don't have counterparty risk. And generally, when you look through all the fees and expenses, it's a much better deal for investors as well. There's a lot of expenses associated with running these semi-liquid structures. That said, we are working with a handful of clients to, again, sort of change the game and put the power back in the investor side to build custom tender or interval funds. And you get a lot of benefits by putting the power in the fiduciary's hands. You can almost think about it like a glide path where you can look across your client base and say, this many people in the 40 to 50 group, this many people 50 to 60, 60 plus. How much liquidity does each group need? How can I map out how to most efficiently run this fund to minimize that cash drag? And you can work on costs as well, because this isn't just a revenue center, maximizing management fee for a mega cap firm. You can really lean into efficiency and building something uniquely well suited to the wealth community. And so we are not allergic to these structures, but we don't think there are many options in market that are really built with the best outcome for the investor in mind. And we think starting with a goals-oriented conversation about where are my clients in terms of their liquidity needs and what's the right tool for that job, and not just defaulting to the most liquid tool, will likely lead to better outcomes.
Thank you for tuning into this episode of Private Markets 360. We hope you enjoyed our enlightening conversation with Jacob Miller, co-founder and chief solutions officer at Opto Investments. Jacob's extensive background in investment management and his innovative approach to creating customized solutions have provided us with invaluable insights into the current landscape of private markets. From exploring macroeconomic trends to discussing the intricacies of deal flow management, Jacob has highlighted essential strategies for investors navigating the complexities of today's investment environment. His perspective on the evolving role of AI in private equity offers a glimpse into the future of investing. If you enjoyed this episode, please subscribe to Private Markets 360. Join us next time as we continue to explore the world of private markets and bring you more insights from industry leaders. Until then, keep thinking critically and exploring the opportunities that lie ahead in private markets.